Good morning. Today we are initiating a deep dive coverage on Pinterest, ticker Pins. While often bucketed with social media peers, our proprietary analysis suggests Pinterest is fundamentally decoupling from the engagement-based algorithms of Meta and Snap, pivoting instead towards a high-intent commerce utility model. We are examining the stock through a lens of monetization efficiency, specifically the convergence of shoppable content and third-party demand integration. We will analyze the trajectory of MAU growth, ARPU expansion in international markets, and the potential for EBITDA margin expansion as operational leverage kicks in. Let's look at the numbers. Our core thesis rests on Pinterest's evolution from a walled garden of inspiration to a lower funnel performance engine. Unlike TikTok or Instagram, where ads interrupt the user experience, ads on Pinterest add value to the user's intent. The company is actively integrating direct links and third-party demand partnerships, primarily Amazon and Google, to reduce friction. Our data indicates this shift is increasing click-through rates and return on ad spend, ROAS, for advertisers, positioning Pins to capture a larger share of the fragmented digital ad wallet despite macro headwinds. Turning to user metrics, Pinterest has successfully rebounded from its post-pandemic slump, stabilizing and growing monthly active users to north of 498 million globally. Crucially, the fastest-growing demographic is Gen Z, creating a robust long-term funnel. While North American growth has matured, the unmonetized engagement in Rest of World, ROW, represents a significant call option on future growth. We are seeing engagement depth improve, with session times increasing as the algorithm shifts from static images to shoppable pins and video content. The valuation story for Pins is largely predicated on average revenue per user, or ARPU. Currently, there is a massive disparity. North American ARPU hovers around $8, while Rest of World is often under 15 cents. This gap is the primary opportunity. As Pins rolls out its ad tech stack globally, even a modest convergence of international ARPU toward peer averages, like Snap or Meta, translates to significant top-line leverage. We model a 15% CAGR in blended ARPU over the next 3 years, driven by improved ad load and pricing power. Post-2022, management has executed a rigorous cost discipline strategy. We are observing genuine operating leverage. Adjusted EBITDA margins are expanding as revenue growth outpaces OpEx. The company has streamlined its workforce and reduced real estate footprint. Our model projects adjusted EBITDA margins expanding roughly 200 to 400 basis points annually for the next 2 years. This demonstrates that Pins is not just a growth-at-all-costs story, but is transitioning into a profitable, free cash flow positive entity suitable for institutional accumulation. This is the pivotal slide for the bull case. The integration of Amazon and Google as third-party ad demand partners addresses Pinterest's historical weakness, fill rates, and auction pressure. By plugging in Amazon's demand, Pins increases auction density without needing to onboard thousands of small SMBs manually. This leads to smoother revenue seasonality and higher effective CPMs. We view the Amazon partnership not merely as a revenue stream, but as a validation of Pinterest's data quality regarding user purchase intent. Let's value the equity. We compare Pins against a basket of digital ad peers, Meta, Snap, and Google. Currently, Pins trades at a premium on an EV sales basis, but appears attractive on a growth-adjusted EV to EBITDA basis looking 12 months out. If we apply an 18x multiple to our FY25 EBITDA estimate, combined with their clean balance sheet, roughly $2.5 billion in cash and no debt, we see an asymmetric risk-reward profile. The premium is justified by the scarcity of mid-cap platforms with 15 to 20. In our bull case, 3 things happen simultaneously. First, the Amazon-Google partnerships accelerate revenue growth to above 20% year-over-year. Second, Gen Z engagement drives shoppable content adoption faster than anticipated, lifting US ARP toward $10. Third, margins expand rapidly due to fixed cost leverage. Under this scenario, we see a path to $4 per share in free cash flow within 4 years. Applying a 25x multiple yields a price target significantly above current levels, classifying this as a top pick. Institutional prudence requires a bear case. The risks are distinct. First, macro headwinds could slash discretionary ad spend, disproportionately hurting brand awareness platforms like Pinterest. Second, competition from TikTok search is real. Gen Z is increasingly using TikTok as a discovery engine, threatening Pin's core utility. Third, execution risk on the ad tech stack remains. If the third-party integrations fail to yield higher CPMs, the stock could re-rate lower to a 12x EBITDA multiple, implying significant downside. In conclusion, we are initiating Pinterest with an overweight rating. The market is currently mispricing the durability of their user growth and the margin accretion potential of the Amazon partnership. We view Pins not as a social media stock, but as a derivative play on e-commerce acceleration. For portfolio managers, we recommend accumulation on weakness, looking for a 12 to 18-month time horizon as the monetization gap closes. Key monitorables for the next quarter: ROW ARPU velocity and EBITDA margin guidance.